Hey everyone, welcome back to Corporate Decoder. Today, Bain Capital Private Credit just filed one of their regular updates, and I am seeing some interesting shifts in their investment portfolio. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reporting on its distributions and asset values, giving us a peek at how their fund is performing. This is a current report filed by companies to announce major events that shareholders should know about. For Bain Capital Private Credit, this filing details their July distributions and gives us a snapshot of their net asset value or NAV as of the 30th of June. Let us dive into the distributions first. On the 24th of July, Bain Capital Private Credit declared a regular distribution for its Class I common shares. This means they are paying out some of the money they have earned to their investors. The gross distribution per share was $0.1875. Importantly, there were no shareholder servicing or distribution fees deducted for this class of shares, so the net distribution was also $0.1875 per share. This distribution is for shareholders who own the shares as of the 31st of July and will be paid out around the 31st of August. Investors in the fund can either receive this distribution as cash or have it automatically reinvested to buy more shares, which is a common feature in investment funds. Now, let us look at the net asset value or NAV. This is basically the value of all the company's assets minus its liabilities, divided by the number of shares outstanding. It is a way to measure the per share value of the fund. As of the 30th of June, the NAV per share for Class I shares was $25.89. This gives us a baseline for what each share is theoretically worth. Beyond the per share value, the filing also tells us the total value of the fund. As of the 30th of June, the aggregate NAV of the fund was a hefty $1,136.9 million. To put that into perspective, that is over $1 billion. The fair value of its investment portfolio, which is what the investments could be sold for, was even higher at $2,216.4 million. This difference between NAV and portfolio fair value is interesting. It suggests that the fund has liabilities like debt that reduce the net asset value compared to the gross value of its investments. And yes, they have significant debt. The report states there was $1,243.6 million in principal debt outstanding. This is a key figure because it directly impacts the fund's leverage, meaning how much it relies on borrowed money to fund its investments. This debt level leads to a debt to equity ratio of approximately 1.09 times. This means for every dollar of equity, the fund has about $1.09 in debt. A ratio slightly over 1 is common for investment funds, but it is a number to watch. It indicates that the company is using a good amount of borrowed money. Then there is the net debt to equity ratio, which subtracts cash and unsettled trades from the debt. This number was about 0.95 times. This is a slightly more conservative view, showing that after accounting for readily available cash and other near-term financial obligations, the leverage is just under 1 to 1. Let us move on to the investment portfolio itself. As of the 30th of June, the fund's entire investment portfolio was valued at approximately $2,216.4 million, spread across 182 different companies operating in 29 different industries. This diversification is generally a good thing, as it reduces the risk associated with any single investment or industry. The composition of these investments is critical. The filing tells us that 85% of the portfolio is in first lien senior secured debt. This is considered the safest type of debt. If a company goes bankrupt, holders of first lien secured debt are the first in line to get paid back from the company's assets. This suggests a strategy focused on capital preservation and lower risk, at least in the secured debt portion. Following that, we see 1% in second lien senior secured debt, which is slightly riskier than first lien, then 6% in subordinated debt, which is even riskier. There are also smaller percentages in preferred equity, common equity, and an investment vehicle. This mix shows a clear preference for debt investments, particularly the senior secured kind over equity. A significant detail is that 92% of the fund's debt investments were floating rate. This means the interest payments on these debts will adjust over time based on market interest rates. In a rising interest rate environment, this can be beneficial as income increases. But it also means that if rates fall, income will decrease. Given the economic climate leading up to June, this floating rate exposure was likely a strategic choice to benefit from potentially higher yields. Next up is information on shares issued and outstanding. As of the date of this filing, through the 1st of July subscription date, there were 45,023,260 Class I shares issued. The total consideration, meaning the total amount of money received for these shares, was $1,154.1 million. This aligns closely with the NAV we saw earlier indicating that shares were likely issued at or around their net asset value. Finally, we have an update on share repurchases and new subscriptions. The fund began a tender offer on May 1st to repurchase up to 5% of its outstanding Class I shares. This offer expired on the 1st of June. It is interesting to see how much of this offer was actually used. Approximately 496,278 Class I shares were tendered, which represents only about 1.27% of the fund's outstanding shares at that time. This is a relatively small amount, suggesting that either investors were not eager to sell or the fund cap was not reached due to limited demand. On the flip side, since the 31st of March, the fund has received additional subscriptions amounting to about $139.6 million. This inflow of new capital indicates continued investor interest and confidence in the fund, despite the low uptake on the repurchase offer. Bain Capital Private Credit appears to be operating with a strategy focused on relatively lower risk debt investments, particularly first lien senior secured debt. The high percentage of floating rate debt is a notable factor, potentially designed to capture higher yields in the current interest rate climate. The debt to equity ratio is significant, showing a good level of leverage which can amplify both gains and losses. The fact that only a small percentage of shares were repurchased, while new subscriptions were substantial, suggests that investor sentiment may be leaning towards adding capital rather than exiting, at least for this period. The biggest opportunities here lie in the fund's ability to generate income from its substantial debt portfolio, especially with the floating rate exposure. The risks, however, are tied to that leverage if the underlying companies in the portfolio struggle or if interest rates change unfavorably. That debt could become a significant burden. The relatively low repurchase rate and strong subscriptions indicate a stable, perhaps even growing investor base, which is a positive sign. What I am actually looking for is to see how these floating rate assets perform if interest rates begin to decline, and how well the fund manages its debt obligations in different economic scenarios. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.